Hi there, welcome to another video with Talk Financials, looking at Vermilion Energy today. It's an international oil and gas producer based in Canada, founded in Alberta back in the mid-1990s, operates throughout North America, widely in Europe and in Australia as well. So global reach, and obviously exposed to some of the serious forces buffeting energy producers or presenting challenges to them over recent years, most notably, of course, the supply disruption, the huge price volatility triggered by the conflict in Ukraine, but as well as the conflict in Ukraine and all that that's doing to energy prices, there's the major challenge to energy producers of the climate change, the drive to net zero everywhere. To give you an example, Vermilion is the largest oil producer, energy producer in France, but under a French law from 2017, it's not going to be an oil producer at all in France by 2040 due to their drive to net zero. So there's an example of the sort of challenges they face, alongside the fact that energy prices and supply and demand dynamics have been all over the place. So Ted's going to have a look through their accounts, highlight a few of the interesting numbers and statistics within them. As usual, give a view on the share price, show us where it's been over recent months and years, and share some insights on where we think it might be going over the coming months and years. We'll also look at some of the macro environment a bit more later on in this video. And as usual, Ted will run the rule over how the CEO is paid in the context of the wider company, and give some further insights. As always, these are just our opinions. We're not qualified to give formal investment advice. We're not trying to do that. We're just looking at some of the dynamics of the company that we think are very interesting. So on that note, I'll hand over now to Ted.
Thank you very much, Johnny, and welcome back to all of our viewers. If you are a subscriber, welcome back. If you're new, then welcome, and please do subscribe to the channel. I think you click the button below in the bottom left-hand corner, if I'm right, and don't forget to like and share the video. Johnny, obviously, in his excitement to talk about Vermilion, forgot to introduce himself. So Johnny Wraith, and my name is Ted Wainman. So without further ado, let's have a look at Vermilion. So if you go onto their website, unfortunately, you can't download their actual annual report. So if you want the report and filings, you've got to go and look at this page here, and then it says if you want the kind of the annual report, you've got to go and look at CEDAR and EDGAR, which is the kind of US filing. Anyway, I've done the effort for you and found it, but it's not exactly easy to find, I have to admit, for the kind of, you know, maybe the non-expert investor. Anyway, here it is, and I hope that you can see these numbers. They are small, and I apologize for that. That's not my fault. There's not a lot I can do about it. So let's start off looking at their profit and loss account. So here we go. We are dealing in thousands of Canadian dollars, which means that when you see turnover of 2,000 million, it's about 2 billion Canadian dollars. Okay, so the turnover of this company is 2 billion Canadian dollars, and they're making a profit of 1.1 billion dollars. Okay, which looks pretty good. That's a 50% net margin. In the previous year, they were on 1.1 billion of turnover, and they made a loss of 1.5 billion. Now, of course, this is the year ended 2020. And these guys are subject to some of the global macroeconomic forces, and many of you with long memories will remember that the price of oil went negative in 2020 when people were producing the oil, but nobody was using it because of everybody. The world was in lockdown, and they were actually having to pay in order to store it. However, I want to highlight, and these are pretty standard numbers that are going on here. There's an interesting number here. There's a profit on a derivative. Okay, so derivatives, these guys will hedge their exposure to the price of oil. So what they're going to do is, because of the fluctuations in the market price, they're going to make sure that they can extract and sell it at a profit. But what is interesting is this number down here, And this is the impairment and reversal of impairment expense. Now, we've seen this before when we looked at, I think it was Mulberry was the last one we looked at. And effectively what they've done is that, this is another kitchen sink moment. What they've done is they've said, we've got all these assets. We're just going to write the value down. And they took a hit by writing those assets down by 1.6 billion Canadian dollars in 2020. And then in 2021, they said, oh, no, hang on a sec. We are going to be using these assets. They do have value. And they wrote them back again to 1.3 billion. Now, this is, quite frankly, this is kind of just manipulation as far as I can make out. This is just moving profits from one year to another. So effectively, they've moved profits, or they booked a loss in 2020 so that they can book a nice big profit in 2021. So let's eliminate those two numbers. And by the way, this is all valid because it's been signed off by our friends at Deloitte. Okay, so they say it's absolutely fine to do that. If you believe them, then that's fine. So when we look at those numbers, if we eliminate those numbers and we look at kind of the underlying profitability, basically on a 1.1 billion turnover in the previous year, they made a profit or a loss of about 120 million Canadian dollars. And in 2021, on a 2 billion turnover, they made an underlying profit of 153 million. So they're basically running at break even. Okay, so I would suggest ignore these results down here, and you'll notice they kind of just stick everything in there. What they don't do is a lot of people will kind of put a line in and say, here's the core operating result up here, and then here are the exceptional items. And so if I kind of, rearrange these numbers, then, as I said, these guys, they're basically operating at a break even in both years in terms of profitability. Let's go to the balance sheet. Here is their balance. Sorry, that's their cash flows. Here's their balance sheet. So the balance sheet, quite interesting. The total assets, there's the kind of the total assets and the non-current assets. 4.8 billion of stuff, so that'll be all the sort of oil rigs and extraction facilities, etc. Big number there. Quite a lot on the accounts receivable. Little bit of an issue here though is this number up here, 6 million Canadian dollars in the bank. So they don't have a lot of cash. Same as the previous year, they're not sitting on very much cash. So these guys, they don't have a lot of cash. And this is a potential issue because if you compare the current assets, which are the things that they have, which are either cash or going to become cash soon, and compare them to their current liabilities, you can see that they have potentially a liquidity issue. So that's a little bit of a question mark, a little bit of a kind of ding-a-ling-a-ling. Is that an alarm bell? So there's the accounts receivable, the people who are going to pay their money, and there are the accounts payable. And basically, they don't have enough money coming in to pay their accounts payable. They're going to kind of rely on their ability to carry on extracting oil and selling it for cash. So these guys are very, very dependent on their kind of future cash flow. Not a lot of room for error in those numbers. In terms of the rest of the liabilities, quite interesting here, lots of long-term debt. Okay, now interesting. So typically in a kind of oil and exploration, if you're exploring for oil, you fund yourself through equity because it's pretty high risk. Once you've found the oil, you can then use debt to fund the extraction. But they are sitting on a lot of debt. You'll notice that figure has fallen from about 2 billion to about 1.65 billion. So these guys, they realize they've got a lot of debt and they are trying to reduce that debt. And we'll see that a little bit later on. And then finally, the equity. Here's the equity down here. These guys are funded through investment by the shareholders. Okay, little bit of a kind of increase in the actual shares, and they have been making losses. So again, not a problem necessarily. So they've historically been making losses, and now, as we said, if you remove those kind of, that accounting shenanigans going on, they're really just, they're not making a profit, but they're not losing money. They're operating at a kind of, a break even effectively. So there's the balance sheet. Nothing else that really jumps out at us. Potentially there's a kind of, bit of an issue here brewing its head. So this is the retirement obligations. This is the pension fund, or the underfunded pension fund. So there's a pension fund sitting, off the balance sheet, and if it's not funded enough, then there's a potential issue, and these guys, this company has to put the money in. That's another billion. So there is our balance sheet. Let's have a look at the cash flow statement. In fact, we'll just have a look at the movement in equity as well. So the movement in equity, if I can find it, here it is. So the movement in equity basically says, quite interesting, last year they paid a dividend. I mean, it wasn't a very big dividend, $90 million, but I'm surprised that you'd pay a dividend in a year when you book a whatever it is, a 1.1 billion loss in the middle of a pandemic. But hey, I'm not running this business. And then this year they're kind of, they're clawing back. They're still sitting on retained losses. They've got a retained deficit rather than retained earnings. But they are, they're starting to try and, reduce that deficit effectively. So here's their cash flow. So interesting enough, the cash flows, and this is obviously our key number here, they are generating cash. So that's a good thing. And they're generating cash mainly because a significant part of their expense is depreciation. Now, these guys, big capital, big owners in capital, lots of capital investment, and therefore that capital is being depreciated. That's a non-cash expense, and therefore these guys are generating cash. And that again may be a reason why that liquidity ratio, that relationship between the current assets and the current liabilities, isn't as big an issue as it might otherwise be. Okay, and I just put a caveat on that, and if anybody wants to share their thoughts on liquidity ratios in the oil and gas industry, then please do use the comments and share your thoughts. Obviously, please be polite. So they're generating cash. They are investing. Now, interesting enough, their investment in kind of, in drilling and development is less than the depreciation. So they're not really they're not growing their assets. They're using their existing assets, and also they are buying other companies. Not a huge amount, but they're buying other oil drilling companies, maybe they've done the exploration, they found the oil. These guys can do the extraction. And in terms of financing, here we can see they are basically trying to repay their debt. So their debt is effectively going down just a little bit, 340 million during the year. So generating cash, using some of that cash to invest, some of that cash to pay down debt. And basically that means that they don't really have much extra cash during the year. And so they went from 7 million down to 6 million in the bank. Okay, and that I think is a potential issue. I'm not sure that they necessarily have to go cap in hand just yet, but that is the potential issue for them. Now, I just want to come on to looking at, we don't usually do this, Johnny, but we do have the interim financial statements. And I just wanted to kind of follow up because obviously the numbers we're looking at are year ended 2021. We are now at the beginning of 2023. So 2022 figures will be coming out in the next few months, we hope. But here is their kind of mid 2022 numbers. So just a few observations. So first of all, net earnings are in at about $646 million. So if that's for the 6 months, if you double that, that's 1.2 billion. Again, we've got this impairment reversal that they're booking. So there is and a gain on derivative instruments. So there's stuff in there which you maybe want to kind of strip out if you want to, if you're doing your analysis and you want to see what's the core underlying profitability of this organization. In terms of the balance sheet, cash, I mean, just they got $675,000 of cash, down from the 6 million that they had at the end of last year. So again, cash flow, I think, is a major, is increasingly a problem. And what we see here is their current liabilities have increased. So current liabilities up significantly, the current assets up a little bit, and the relationship between their current assets and their current liabilities is getting worse. which suggests to me that maybe they're struggling to pay their suppliers. Now, if you struggle to pay your suppliers, at some point, your suppliers will stop supplying you. And of course, if you don't have enough cash to pay your staff won't turn up to work. So I think there are cash flow alarms all over these guys. You can start to see the debt has started to increase, suggesting that they are having to borrow money in order to stay afloat. And I don't think there's a little bit of extra share capital coming through. So we should be able to see that in the movement in share capital. If I can just go here we go. So they're not actually raising any money. This is all kind of share awards to staff, but they're not really raising any cash from their shares. So it's looking interesting, Johnny, I have to admit. Now you mentioned also we're going to look at the CEO salary. Unfortunately, because it's it's Canadian listed, we don't have access to the kind of the CEO salary information. I may be wrong there, but I couldn't find it, so I'm not going to talk about that. What I am going to do though is just to mention that this is a request from one of our viewers. This is Miguel, who asked us to look at Vermilion Energy and to say that if anybody else watching this has a company they particularly want us to look at, then please do just let us know in the comments section. And give us some background, tell us why you're looking at a company, because we have people who are looking to invest, go long, people who are looking to invest, go short. We have people who are looking to get a job here. Maybe they're you want to supply them, maybe you want to be selling to them, maybe your university, for example. I was working at the London Business School recently. A lot of their finance students said they've been kind of watching these videos to kind of get a little bit more flavor on particular companies they were studying for their master's degree, for example. So there's lots of people out there who are interested in these videos. However, we did say that we were going to finish looking at the share price. So here is the share price ever since they started trading, floated. And it's been quite a rocky ride. So if you are an investor in this company, you have made and lost fortunes, as far as I can make out. So what can we see? There's the global financial crisis. There's lockdown, for example. So yeah, quite an old rocky ride for you. Let's zoom in and have a look at the sort of last 5 years. So last 5 years, again, there's COVID hitting. So really kind of just seeing a sort of decline, and then it's bounced, and then it's all the way back up again, and now it's going down again. So there's no real kind of direction. I mean, it's you can put chart lines on it and hope that it's going to hit the bounce and off it goes, but I'm not convinced by it. Interesting enough, so the market cap is 3.35 billion, and that is actually almost exactly the same as the net asset value of the business. So the balance sheet is, I think, at the year end it was 2 billion. So you're kind of in the same ballpark in terms of it's not massive. This P ratio here, it's 3 times earnings. I would suggest to you that is a massively distorted figure. So on the face of it, it looks cheap. Oh, wow, I'm going to buy this company. But as we discussed, I think these guys are operating at a break even. I don't think that they're making a profit. And that P ratio is driven through that write back of the investments that they originally wrote down. So yeah, 3.35 billion on a balance sheet which is worth 2 billion, leaves you with about 1.3 billion of goodwill. Is it worth it? I have no idea. Yeah, it's would I invest in this company? Well, I'm not a shareholder, Johnny, for full disclosure. As a result of my analysis, I'm not planning to buy shares in this. Would I go long or would I go short? I have absolutely no idea. I kind of feel that, but it's an interesting one. If you're a short, then I think it's quite an interesting one, because they do have a lot of debt and they don't have a lot of cash. So it might be worth a kind of, further digging around just to see, well, actually, if you're going to short a company, you want to be shorting them, before everybody else rather than after everybody else. So, it's quite an interesting one. Yeah, there you go, Johnny. They're generating cash, but they're not really profitable, if that makes sense.
Yeah, well, not a ringing endorsement, and I think you're not alone in that, actually, Ted. I was looking at a few of the recent developments while you were chatting away there, and in the last few weeks, actually, we've seen two big Canadian brokers downgrade their target for Vermilion share price. They do both expect it to rise from here, but to a lesser extent than they were saying before. And there's sort of two major drivers of that. One is the fact that gas prices have recently become softer, of course, and that share price you were showing, not surprisingly, somewhat correlated with gas prices. So that's something of a headwind for them. And also, of course, even when gas and oil prices were high, it's not a one-way street for these oil and gas producers, because, of course, windfall taxes have become a big issue of late. And I think from what I saw anyway, Vermilion expects $250 million of European windfall tax charges relating to 2022 and 300 million in 2023. So, even if those prices do stay high and they're generating more income as they produce oil and gas, there is obviously that offsetting pressure of higher windfall tax charges, which you won't be surprised to hear they're extremely opposed to. So lots to look at there. And as I say, those brokers at least do see the share price going higher, but share some of your concerns, I think, about the outlook and are a little bit less bullish than they were. So that's quite interesting, I thought. I don't know if you've got anything to say about that specifically, but seems to fit what you were saying, I'd say.
Only in my experience, if a broker says buy, then it's a hold, and if they say hold, it's a sell, and if they say sell, then it's a short. But right. Maybe that's a bit too generic.
Well, I mean, I think, I know what you mean. And given that they are still saying buy, but they're saying it in a more lukewarm way, maybe, at the very least, it's a good time to be extremely careful and sort of keep a close eye on how this company's performing, on top of the issues that you raised, which, are perhaps further causes for concern. That's the way I interpret everything that I've seen today anyway. Well, thanks, Ted. Just to repeat, these are Ted's opinions, our views on what we're seeing around this company and the sort of wider macro geopolitical environment they're operating in. It's not formal investment advice, and you'll have your own views. So please do add any comments, any insights to the chat. We're certainly interested to see what everyone else thinks of this, and perhaps we're missing something that's either going to turn opinions into a sort of more bullish one or give us even more cause for concern. Also, please, like, share, subscribe if you've enjoyed what you've heard from Ted today, and we'll see you next time.
Thanks a lot, Johnny. Catch you later.
Good luck.
Hello, thank you for watching that video, and I hope you found its contents useful. If you want to know more about what we do here at Talk Financials, you can find out on talkfinancials.com, where we will explain how we design, develop, and deliver training workshops for companies all over the world. We've worked with over 300 companies in over 35 countries around the world, helping them to understand financial statements, to understand business finance, and to become fluent in the language of business finance. If you're interested in developing your own skills in how you read and interpret financial statements, I've developed an online workshop which is available. All you've got to do is click on the QR code there, point your camera at the QR code, and that will take you through to an online workshop, and it will help you to improve your own ability to read and interpret financial statements. I've also written a book called How to Talk Finance, and again, that is available. If you click on the QR code, it'll take you through to the Amazon website, where you can buy the book either as a hard copy or as a Kindle edition. And that's really everything from me. I'm on LinkedIn. It'd be great to stay in touch. If you'd like to contact me, then again, just click on the QR code and send me a message. And good luck with your financial analysis. I hope it goes well.